Good evening, everyone. So tonight I want to talk about Fibonacci levels and how they can be a very useful technical tool that you can incorporate into your trading strategy. On your Plus500 platform, you'll find this tool very easily simply by looking up the Fibonacci. So to jump straight in, there are two scenarios or types of Fibonacci levels that we can use. The first are Fibonacci retracements, and I'm just going to use a simple example on screen here of the S&P 500 daily chart from the beginning of the year. So, if prices hold here at the March 3rd high and begin to accelerate lower, I can use the Fibonacci retracement tool to gauge where prices might find support. And that's all I'm trying to do, is identify where prices might find support if the market enters a correction phase. And then the other scenario is using a Fibonacci extension to gauge where a market might find resistance if it accelerates through a prior market high. And you can see this on Germany DAX, the Germany 40 index in December as prices broke above the prior high from July 31st last year. And there's really no limit to the scenarios that you can use the Fibonacci tool. It can be applied to a bullish trend, like we're seeing in most equity markets for the last few years, or a bearish trend, like we're seeing in natural gas, or even in a sideways range or consolidation phase, like we're seeing at the moment in oil or the UK 100. So what do we need to know about using them? Let's take a closer look at the Fibonacci retracement, and I think it's useful to provide a broad definition here. It's a measure of a potential recovery in a downtrend or a potential correction point in an uptrend. It is not necessarily a trade entry or exit point, though if you have a favorable position, you could factor this in when considering whether to take a profit. The way I think of Fibonacci points is to watch them closely and see if there is any reaction near that price point. If there is, that can help inform my decision process on the next trade I might want to take, which is obviously dependent on my overall personal view. Okay, so let's talk about how to generate the Fibonacci levels in our charts. We first need to identify the closest or the most recent significant low to high, and that's if prices are in an uptrend, or high to low, and that's if prices are in a downtrend. So just using this S&P 500 chart here, we're looking at an uptrend from March 12th at 38.39 to the high on July 27th at 46.34. So now I can use this range to project my Fibonacci retracement points. And the important points that we're looking for here are the 38.2% retracement, the 50% retracement, and the 61.8% retracement. And you can see these lines on the chart here. So if prices do start to sell off and we enter a correction, I'm going to be looking for these retracement levels to potentially contain the sell-off. And in this instance, we actually see that the 38.2 retracement level didn't do much for us. But there was a pause at the 50% retracement level, and we actually got a fairly sizable recovery in prices from there before new selling materialized again. As prices moved lower on this leg, we started to head towards the 61.8% retracement level. And this ultimately held, actually, and we saw a very significant rally from there. And that eventually took out that July 27th high here and took us to a series of new all-time highs. Most recently, of course, which is last Friday's high at 52.57. Now, obviously, this chart is actually very useful because the Fibonacci points kind of confirmed, especially that 61.8% retracement level, confirmed a lot of price congestion support at that 41.40 area. And that goes all the way back to April, May, June of last year. So it was interesting to see that the Fibonacci level actually confirmed that as a support. So as an additional technical tool, I think it was incredibly useful in this particular instance. And the last point I want to make on this slide is that it can be used over any time frame. And we'll take a quick look at the Germany 40 just from the beginning of the month. On Friday, we saw that high of 17,923 and a pretty significant sell-off. But again, using the Fibonacci retracement levels, we did see a little bit of a reaction at that 38.2% level. And then towards the end of the day, we saw prices holding at that 50% level. So, clearly it can be used in shorter time frames too. All right, let's take a look at the other scenario. That's Fibonacci extensions. I've always found this to be an incredibly useful tool, especially in markets where price action is at an extreme. And that can be either at a new cyclical or historical high or low. And this lends perfectly to the current equity environment where we have made a series of new all-time highs in many of the global equity indices. For me, this is where Fibonacci extensions really shine. There is no prior price activity at new extremes, so without a tool to estimate price movement, it's really difficult to predict and stay in a trade. Fibonacci extensions can give me that confidence to help me project where the important areas are to the upside. I think there's probably another aspect to this as well, and I think it's given a complete lack of price information at historical levels. Many traders and entities only have Fibonacci targets to trade from. So I suspect there is, somewhat of an element of self-fulfilling prophecy or perhaps gravitational pull towards the most commonly watched or projected price points. All right, so when we look at the USA 30 here, it's a near perfect example of this. Again, we're looking at the move from the then all-time high from July 26th last year at 35,844 down to the corrective low on October 26th at 32,411. As we break up to new highs on December 1st, we now need to project where this rally could end up. So our Fibonacci levels are still 38.2%, 50%, and 61%, but now we're going to add now we're going to add the entire corrective move. So that's plus 100%. So that makes our projection levels 138.2%, 150%, and 161.8% off that October 26th low. And we can actually keep going. And if we get past that 161.8, the next level would be 200%. If the move continues to evolve without a significant correction, the next level after that will be 238.2%, 250%, 261.8%, and so on and so forth. On this chart, the first Fibonacci extension points at 138.2% provide an absolutely no resistance whatsoever. But the 161.8% move and then the 200% move area both provided a significant reaction where prices paused and corrected slightly for a few weeks in each instance. To finish up, let's just take a quick look at the US 100 and Germany 40. And we've got some important themes and data points this week and next in the US. First off, tomorrow we'll get the latest PPI data on the heels of a stronger than expected CPI this past Monday. And this is going to make the Fed meeting next week a very critical event. Markets are continuing to show optimism on the inflation front, yet the hard data points haven't really confirmed that. So I think there's a clear risk that the Fed walks back on market easing expectations. Forward rate guidance is going to be key, and perhaps if the result is rates remaining higher for longer, then we could see some corrective pressure building on equity markets. So I think what Fed Chairman Powell has to say is going to be very, very interesting. If we look at the US Tech 100 here, I put in a Fibonacci retracement from the low this year on Jan 5th at 16,335 to the high just this past Friday at 18,689. If prices do start to correct, our first retracement support, the 38.2%, comes in at 17,786, with the 50% retracement just above 17,500, and then the 61.8% retracement support at 17,237. So if a correction does start to develop on the heels of a more hawkish Fed, these are potential support areas I'll watch very, very closely. And then finally, moving to the Germany 40, technically, it still looks very, very constructive. On the strategy side, the ECB last week downgraded EU area inflation and growth slightly for 2024. That's in large part due to a lower contribution from energy prices. Against that, we're seeing a slight uptick in CPI data in China, so potentially, perhaps early signs of consumer recovery. However, there's a good chance that data may be distorted by holiday spending for the Lunar New Year. At the producer price level, data points actually are still remaining pretty soft there. Anyway, as far as price is concerned today, price action has brought a marginal new all-time high. And the Bollinger Bands have been widening with a rising mid-average. So technically, this remains a very positive picture overall. I do want to keep an eye on potential retracement levels, as there are significant event risks surrounding the PPI and the Fed this week and next. So using the advance from the Jan 17th low at 16,462 to current highs, those retracement levels are currently at 17,431 for that first retracement, the 38.2%, 17,247 for the 50% retracement, and 17,068 for the 61.8 retracement. On the upside, I didn't actually put it on here, but on the upside, our next Fibonacci target is actually 200% of the sell-off from July to October last year. And that comes in about 3% above current prices, a little above 18,500. So if markets shrug off the event risk over the next several days, I'll be looking to react. I'll be looking to see how prices react near there if we see it. So that's it for me this week. Have a great evening and happy trading for the week ahead.